Okay, I am sitting here on my balcony. It's early in the morning. I'm hearing birds. If you hear birds in the background, it's, you know, March Day in Rwanda, and it's wonderful, frankly. So what else should I do but make a video on financial statement analysis? And if you have my Google Drive, you go to chapter 4 and slides, and then you go to current slides, and in the current slides I have these different categories. And the slides we're going to take today are the ones just from general finance, and I'm going to go through the financial analysis slides. In addition, let's go back just a minute. Okay, what's going on? Oh shit! What the hell's going on now? If you go to the slides, I have added in corporate models a section called financial statement analysis, and I put one of the files I put here is, I hope I did, spreadsheets. I thought spreadsheets for financial statement analysis, and I also put these on my website that everybody says sucks, so I gotta hire somebody to make it a lot more snazzy. Go to hell. Really. I'm not into snazzy things. I want to give you content, and I want to show that I'm not some wasting time on some little picture that goes around and around. Okay? Really. Jesus. That's really going to make a big difference in my life? Nobody's going to buy my shit anyway. But you know, whatever. So I'm doing this. And now, here's what I thought when I was going to teach financial analysis. I thought, oh, this is going to be boring. I got to stay awake. That's accounting. Oh, no. I haven't done accounting since, early 1980s. I don't want to tell you really how old I am. My God. And they said, oh no, you got to do this so we know about corporate value, ECM, equity capital markets, DCM, debt capital markets, M&A, project finance. They said this is the fundamentals, and I thought, okay. And they were right. I was wrong. I was the one who was wrong. They were the ones who was right. Korea Banking Institute. Here's what they said. They said, go through the financial statements. And I thought, I can go through this. And then when I get to other comprehensive income, I'm just going to kind of skip over that. Hiding statements, forget about this. Impairments, things, okay, we can talk about it. It's halfway interesting. Affects ROIC ratios and, all that stuff. And then I was so wrong. I was so completely wrong. If you do corporate analysis, you got to really understand this hedge accounting. You got to understand exactly why people put XYZ into EBITDA and all that. So don't get off yet. Don't. Well, you can. I don't care if you watch it or not, really. Okay. So we're going to talk about, in this how financial statement analysis works. I'm going to start with a ridiculously simple example, and then I'm going to go through some better things. And they wanted each line of the financial statements. I go, what? I'm supposed to explain what revenues are? And then I said, okay, well, deferred tax expense, and all that. And then I said, well, this financial ratio analysis, it's not all that very interesting. The interesting thing is making forecasts. Because everything in life, unfortunately, the past you can't do anything about. All those stupid, ridiculous, oh, that stupid saying they use, whatever, in the U.S. Can't influence what, can't control and all that stuff for alcohol. I drink too much, probably. We talk about the future cash flow, which that's something we don't know about. That's interesting. And putting a risk around our future cash flow forecast. I don't care what you call betas or anything else. That's really what this is all about. Now, is a context, I always start with corporate finance, project finance. Say corporate finance like a family, a country, a city. That doesn't die. You have some history. Project finance, no history. Just consultant studies, engineering reports, contracts. A whole lot of different ways to look at project finance, like a relationship or a person. There's a birth and a death in different phases of your life, and you look at different financial ratios. So we're going to talk eventually about the financial ratios you look at. And then what I should have done is really started with this ridiculously simple example to explain accounting. This is something I took out of a book. That you start at the beginning with 50 goats, you end, that's a balance sheet. It has a one time. Over a period is a profit and loss and a cash flow. How you increased your goats by 7, that's profit. Increase in assets, cash, increase in whatever. That's over a period of time. And then so I said, let's start with a nice little simple business. And I looked on the internet and found this little food business. So this person from Thailand selling street food, which I love, by the way, she's got a little pot. And I said, well, let's say she has some cash at the start of business. And then she buys some food, sells some food. She buys food for 100, sells it for 200, gets cash at the end of the business. It's like that goat example, isn't it? So we have a balance sheet with a starting and end. Her equity in the business, her worth of the business is 300. At the end, it's 400. That's the balance sheet. Over the time period, she made 200, took 100 as an expense, and got a profit. And her profit is the difference between the assets. I know that's so absurdly simple, but that's how we start. Now we'll make it a little more difficult. Now she can't live on nothing. She's got to eat too. She might want a bicycle or a car or something. And so she's going to take a dividend out of the business, which is more than her income she's going to take out of the business. So her cash actually goes down. Her cash in the business goes down because she takes it out. Now, she's got an income statement the same as we did before, but this time we have to add a cash flow statement that occurs not in the start and the end, but over a period. And she starts with her income, takes away the dividends, and the cash flow statement has these 3 little parts. And to get from the equity balance up here to the cash flow balance, we start with an opening balance, add something from the income, take it out from the cash flow. That's what we always do. I wish I would have just started the class like this and told them that's the basics. Why? That was really bad. Shit. I did such a shitty job. Now she's got to buy this pot. So she's got to make a capital expenditure. That's the making the pot. Where did I say that? Cash cost of buying the pot. That's a capex, and we're going to say this pot's going to last her 4 years. Maybe it lasts a little more. Okay, this time the things get a little more complicated. This time we have to take that pot that lasts 4 years, compute a depreciation expense on that pot, and we put that in our income statement, and we allocate that cost over 4 years. And then we put in the cash flow statement, we of course add it back, but we put another investing section for CapEx. And then we get our equity balance again. This time we owe income minus dividends, get the cash, the ending balance, and we take all this junk and we say, well, what's the real cash flow we had? Well, we got our 100 like before, but this time we spent 250. And the basic real question is finance is when you get the money, do you spend the equal money? So I made another example here. Let's say you keep buying all these pots, and you buy all these pots, and then your revenue never revenue never goes up. Here's the cash flow statement and the income statement. We show all this shit. The cash against it goes negative. That's like a debt. I'm going to call negative cash a debt, if you don't mind. And then we put all these little things. These are going to be in the notes to the financial statements. everything on the balance sheet is going to have an opening balance, some change, and a closing balance. And if we look at our cash flow, we get our EBITDA, take away CapEx, and we got a negative number. Now, if you increase, and that's the idea of a CapEx, is to increase the EBITDA. So you start with your cash flow, and you make a balance sheet and income statement all the same structure. We have all the same stuff here, but this time we have our income going up, and the real question is, are those CapEx worth it in terms of getting the higher EBITDA? She's expanding and buying more and more pots. Okay, and I had them do an exercise. What they had to do is just start with this thing and then fill all these things in, so you see that the opening balance and the closing balance comes from the income statement. And they said, put these little things at the top so we can see what the formulas are. So you first compute depreciation, and then you put in your operating costs and your cash flow, and you got your balance sheet at the ends. And now let's look at real financials. Here's our revenues, our operating expenses. They put depreciation here on the profit and loss statement. They have some impairment. They have some different expenses. Then they have their own interest expenses. They get their income. The balance sheet, they separate the cash, the plant, the long-term assets, liabilities, long-term liabilities, equity. This is Chesapeake, a big, I made another video on this, a big oil producer, and I showed financial statement analysis was so important here, more important than all this other crap. Their CapEx was always more than their EBITDA. I gotta be a little careful. Maybe 1 year it wasn't. And their earnings, their EBITDA never justified their CapEx at the end, and their net EBITDA stopped growing. And then, of course, in 2015, 2016, it fell through the floor. Their stock price went down to zero. Now the cash flow has some income, then investing, and then financing. This is like the dividends, this is like the CapEx, this is like the income. And that's how we start. Now, let's go and talk about EBITDA. And that, here, why don't we just use cash flow? Why don't we just use cash flow right here? We could use net cash flow from operating activities and be finished. Why do we have to go through this EBITDA crap? Okay? And there's no rule for computing EBITDA, and I'm going to talk about Standard & Poor's. Now, when I talk about Standard & Poor's, you should look in folder number, chapter number 2 on the disk. And in chapter number 2 on the disk, I put a little thing on credit analysis. And in the credit analysis, they have, Standard & Poor's has kind of the default studies. I collect a lot of this stuff. S&P default studies. And let's look at, how about we'll look at a 2011 default study. That's you just go to the internet and collect these. There's another video I'm going to do sometime on here. 2011 Lehman Brothers 144, and you look at another one that dwarfs everything else. This company was rated single A. What a bunch of crap. Rated single A the night it went bankrupt. It obviously political, obviously nothing to do with anything real. Okay? Now, but I'm going to talk about how they have these confusing things. S&Ps, they enable to better align a company's reported figures with whatever in the hell that means. We're going to try to figure out what it means. It means you can't just take numbers from the cash flow. Accurate portrayal of ongoing business, that's okay, but later they get so horrible. And they say EBITDA aims to focus on operating activities. That means no financing. That means no crap from selling assets. That means no crap from derivative gains and losses. What are they really doing? That's what we're trying to do. And they say, well, for example, if you have some in your income statement, if you have some other income, that other income from associated investments might include gains or losses on the asset values. Okay. So the first big point is that EBITDA is not on the income statement. And then we look for trends. And then we're going to say, how do we make some of these adjustments in the EBITDA? I use Apple all the time. Apple has, if you buy Apple stock, you're buying 150, 160 billion of cash that they like to stick in other places to avoid the taxes. That's, I think, why they do that. But you're also buying all the factories that make all those iPhones and all iPads. And you're paying a ton for those iPhones and iPads compared to the amount they invested, I think. Because if you look at their return on equity, it's about 30%, not very great. But if you realize that they're making 1% on all that cash balance, their core operations are making a heck of a lot. And what we're trying to do with EBITDA is focus on those core operations. Okay, now, here's an example. So here, this is a simple example. We have a company, and they had some stock-based compensation. What do we do with that? They had some restructuring expenses, but then they said, out of that, 35 is non-cash. Whoops. So 75 minus 35, that's how much they actually paid. What should we do with this stock-based compensation? That's non-cash. Should we include it in EBITDA or not? These are funny little issues. Here's what I say. You can compute EBITDA from revenues minus expenses and get this, or start from the bottom and go all your way up. You should use cash, and we should call that payment you made to the stock employees, you should call that really part of the EBITDA, because if you didn't pay them in stock, you'd have to pay all those rich guys in cash anyway. Okay? Then EBITDA doesn't really, this is a big deal. And this is a big deal. People, this is crazy. Those idiots at Standard, I shouldn't say that. They do the same thing. If you have debt to EBITDA of 5 times, if you have an asset the last 5 years, you're no way going to get paid on that asset. If you have an asset of 20 years, it means completely different. Debt to EBITDA doesn't account for the life of the CapEx in it. So that's what this example does, and now you can go through on all of these little things. That file I showed you has all those little examples. And it's key to understand. EV to EBITDA does not mean the same thing for something that has life of 2. Debt to EBITDA does not mean if it's 2 or 5. That's such a key point. People don't pay attention to it enough, I think. And then EBITDA can be adjusted for things like exploration expense, rental expenses, because people account for things differently, and that's kind of Standard & Poor's things. And to do that, you understand what a capitalization versus an expense is. If you have a dry hole, if you drill for oil at shale gas, you're probably going to find it. But let's say you drill a dry hole. Should you call that a CapEx? If you call it a CapEx, you say that's a future benefit. And you say, well, part of the cost of drilling is we know we're going to fail, so we're going to call that part of our, if we don't drill, we don't find anything. That's an asset, because that's just lumped together with all the others. Other people say, no, that's an expense. We're never going to get anything back for that. And half people do one and half the other. So if you have this, if you have some exploration expense, one company has it, one company does, the EBITDA is going to be different. But if you add back the EBITDA, since the exploration company for this one, called Full Successful Efforts Accounting, since they capitalize it, it's all going to come out. Okay, then we can do the same thing for airline companies with leases. Okay, and that one we use EBITDA. We take out the rental expenses, because some people might call this capitalize it and put it in depreciation. Other people call it a lease and operating expense, and God knows the accounting rules. Just take the damn thing out, put the leases as capital items, and then you're going to be the same for the two kind of companies. Okay, and the question here now is, can EBITDA really work to pay back debt? And the answer is no. And Moody's has these little stupid things that don't mean anything. Here's the problem. EBITDA is not interest. If you have a debt to EBITDA of 20 times, that's horrible. You can't pay off your debt in 20 years. You got to pay interest and maintenance capex. They don't figure out maintenance capex versus actual capex. Eurotunnel had 20 times debt to EBITDA. It obviously couldn't come close to paying the debt. The interest was more than, whatever, the 20 times. 20 times debt to EBITDA. If we take 20 on the top, 1 on the bottom, 20 is debt, 1 is EBITDA. 20 times 10% is 2. 1 on the bottom is EBITDA. 1 minus 2 is negative. You can never pay it off. So you could compute FFO like Standard & Poor's does, and they make it so damn confusing. And all you do is you take it says take net income plus depreciation plus deferred tax, not current tax, plus other non-cash items, blah, blah, blah. And really, it's EBITDA. At the end of the day, FFO is net income plus depreciation. It's EBITDA minus interest minus taxes, because you have to pay interest and taxes before you can pay off your debt. So FFO to debt is really better than, debt to FFO is really better than debt to EBITDA in terms of measuring how long we get to pay off our debt. So here's a summary of why EBITDA is useful. It's useful because we can think about fundamental operations. It's good. It's good for repaying debt. Now, somebody made a book and said, no, it really sucks. So that's what that one says. And here's EBITDA they call it PTT. Oh, assholes! They say, oh, this is the PTT. Peak to trough. Peak to trough. Oh, God. Okay, and then it's the primary source of repayment, whatever. And then I have all this stuff, which I get so excited about, downloading the PDF. Please. That for me is so exciting, figuring out how to do that. Okay, now I used an example, so we take the EBITDA and we say that, and we make some adjustments. In this case, Chesapeake Energy had mainly depreciation and impairment. Interest expense was not capitalized, so here's what they had when you looked at them. Samsung, I did it with Samsung too. They had this mess. Samsung had all these, proceeds from sales, decrease in loans. What do we take? Which ones do we use on the cash flow statement to make an adjustment? And we have to get interest right and EBITDA right. Okay. So here's the cash flow from Chesapeake. If they have some, where is this? Sales from assets, they're negative. They're negative cash flow because the gain on the sales of these. No, this is just proceeds from the sales, CapEx. I think when you take CapEx and compare it to EBITDA, we should use both proceeds and CapEx, okay? What should we do with R&D expenses? Well, different companies do it differently. I used to think, oh, who cares? People, God knows when somebody's sitting in Cupertino, California, and they're making some sort of analysis sitting at their desk. Who knows whether it's research and development or anything else. They might have to classify some time card and say it's CapEx. Here's what, in Samsung, they said 14, gazillion, whatever, millions of billions or whatever it is. They out of their total expenses, look how much more R&D was than their total. Should we call that a CapEx? We should. Because if a company, I don't know if I believe this, maybe somebody can tell me, Nokia stopped making R&D, they said. I don't believe that, by the way. And they say, oh, that's why it fell apart. Maybe, but we'd really want to see, if you're going to stop making CapEx, you're going to fall apart. doing this financial statement analysis to get a picture of what's going on with a company is really interesting, and you've got to be careful. Okay? And this is what I said, well, what is CapEx? The idea of CapEx is provided future benefits. R&D is supposed to provide future benefits. We don't know what exactly it is, so some people expense it, I guess. Interest expense, now that's the big pain. Now, here's what this company did. Now, if you are building a project, I'm sorry, there's a tractor going on. I hope you're not hearing this tractor in the background. If you're making building a tractor, and it's taking 4 years, and you've made a loan specifically for that tractor, and you're paying interest on that loan. Now, how in the hell would you know if that loan is specifically for the tractor or something else? Okay, you'd capitalize that expense just like that's a capital item. That interest expense is not current. It's going to provide future benefits. God, thinking about this is a pain to go through. And here's this Chesapeake. They said out of all this interest they pay to the bank, 600 was interest capitalized. Now I don't believe that for a second. But they said it because they're drills. How can you say that interest is only associated with the drills and not the other stuff? God, it's hard. So I said, well, if you're going to compute, interest coverage or debt service coverage, or any of these things, whatever these other ratios, I think you should use the real interest. And then we got to talk about the gain on fair value hedges and all this. Oh shoot! Oh God! Okay. And what do we do with debt issuance costs here? Well, Standard & Poor's, we'll use them. They say that debt issuance cost is like an interest expense. They're probably right for that. So even though it's non-cash, we're going to call that interest. What a pain. These are all judgments you take. So when you do all of this, you get your income and you get your EBITDA from both the indirect method and the direct method. And it's the same thing. You can take your OPEX, add back depreciation, impairment, do something with other income, take net income, subtract depreciation and impairment expenses, and then we can what's this? Indirect method. And then we don't include other income, so this is a different way. And we can compute our FFO, which FFO takes the interest, EBITDA minus the interest minus the tax. Or you can take the FFO, start the income, and add everything back. This is supposed to show, well, operating income had this big fall because of big impairment, and EBITDA is higher than operating income, so we have more cash flow because we don't have depreciation. I'm going to stop here and continue because I want to make sure our thing worked.